Hello, this is Brian Rezny, president of Rezny Wealth Management. One of the things that I want to discuss a little bit is about this inflation front. Inflation's been coming down quite a bit. We're on the right path for lower inflation. But some of the numbers that came out in the last few days have been slightly elevated. Remember, nothing goes down in a straight line. You're going to go down a step or two. You might come up a half a step, go down a step or two. So we are seeing inflation trending in the right direction, but it's still higher than the Fed target. So what does that ultimately mean for the markets and the bond market? I see the stock market, we obviously had a short-term sell-off, not much at all, maybe 1%. Ultimately, if inflation keeps trending down as we predict as we go through these now summer months, I think we're going to see potential for better returns in the equity market in the U.S. as long as earnings are growing. Remember, earnings grow, stock prices often go up along with it. One of the things that I want to stress is the bond market has been an area of just complete misery for many investors. Most investors don't invest correctly in the bond market. They think bonds are safe. They think you buy bonds and hold them to maturity. Ultimately, bonds should be looked at as total return investments, meaning you're looking for that dividend you're receiving or that interest income from that bond, and then the gain or value of that bond. So there are times where you want to buy a bond and hold it to maturity. There's other times that you buy a bond and maybe your intention is holding it to maturity, but then the economy changes and the cycles change, and that basically the Fed reduces interest rates and that bond value goes up, and it may make sense at that point to sell that bond for capital appreciation, because if you look at yield to maturity at that point, it may be very low. So again, bonds are not meant to buy and hold to maturity. They're meant to buy, produce an income, and produce what we consider total return. Sometimes you keep bonds to maturity, sometimes you don't. I think a lot of investors who really had poor returns the last 2 years, and really this year in addition to the start of this year, are investors who had the wrong kind of bonds in their portfolio, the wrong maturity level of bonds in their portfolio. I think ultimately investors have to be conservative on their bond allocation. Don't overexpose themselves to bonds right now. And if you're trying to be a little more cautious and conservative, it's better to hold some cash, make slightly less interest, instead of losing a lot of value in the bond market. Again, interest rates go up, bond values go down. And that's what investors have seen ultimately in their portfolio the last 3 years, unless you own shorter term duration, floating rate type bonds, which is what we have been doing and or have recommended through my TV and radio shows. If you're not a client of the firm, it's time you became a client. Call us for a consultation. We do manage larger portfolios of $1 million and greater. Make sure you have yourself a safe and profitable day.